Hello and welcome back to All Things Money. I'm your host, David Blain. Thank you for joining us for today's show. If you missed the first segment, we were talking a little bit about what happened last week in the Japanese stock market, a 7% decline in one day on Thursday, what that may mean for you as an investor here in the U.S. If you missed the first segment, head on over to our website. In a week or so, we'll have archived copies of the show posted. That's dlblain.com, www.dlblain.com. Okay, during this segment, I wanted to tackle one of the most common questions we get in our office that I've seen it posed many places. It's one of the very things that people worry about, which is, should I pay my house off or not? What's the right way to structure my debt? In fact, we have a client that's just buying a new house, and they sent me an email over the weekend wanting advice on this very topic. It's a very, very common question, and there's a lot of misconceptions. Of course, if you go to the debt-free side, you know, there are certain prognosticators and people on the radio and TV that are all about debt-free. Now remember, the advice that I'm going to give you here, don't run out and go get yourself into a bunch of debt and overload yourself. That's not what we're saying here, but I do want to give you an alternative scenario to debt. And there's nothing wrong with having a mortgage on your house. Some of the people, that's their goal, is to pay their house off. Other people don't really care. I mean, if it's certainly a goal, we want you to achieve your goal. But from a financial standpoint, we're going to talk about the finances of debt and why it does not always make sense to pay your house off. Now, people say, well, you don't want to pay your house off because you want us to invest the money with you, and you certainly have to weigh that, with the source of the advice that's coming from you, that is coming to you. I think that when you run the numbers yourself, you'll see the inherent advantage that someone has that prudently uses debt. Once again, we're not advocating, if you have no savings at all and you run out and you spend $300,000, $400,000, $500,000 on a house, no, that's not what we're going to recommend. We're talking about someone that has steady income that can manage both a mortgage payment as well as an investment portfolio. So anyway, let's get into the details. What it boils down to is that if the rate of return you need to reach your other goals, and for the purpose of this discussion, we'll assume this sort of nebulous goal of retirement, that you have a retirement goal, that at some point you would like to stop your full-time work and live on your investments, pension if you had it, Social Security, whatever. Okay, so if the rate of return you need from your investments, once again, for this sake of argument, we'll assume it's a retirement account. I like the Roth IRA. We'll assume it's a Roth. Also, it helps keep the math a little simpler here for radio and TV. But if the rate of return you need on your retirement assets is higher than the debt you're paying, it does not make sense to pay your debt off. Now, if you're 65 and you have $2 million in your portfolio, or we see in this area sometimes a lot of federal workers, my parents included. If you have a steady pension that's guaranteed, you have maybe a decent Social Security check, and you want to pay your house off, different story. You're in retirement, you have the assets, different story. We would probably not advise that you do it, but it's a different scenario. We're talking about here that someone that has, 15, 30 years until retirement. And so you're looking at, well, should I put money in this bucket or should I put money in this bucket? Should I pay that house off early? Should I take the 15-year mortgage, minimize the debt, or should I take the longer 30-year mortgage? And I think, intuitively, I think people understand this. Once again, this is not designed to tell you what to do. For a lot of people, they rate paying their mortgage off as 2 to 3 times as important as other goals. Me personally, I don't care. I like to do the smartest financial thing and save my emotional decisions for, my family and wife and kids and things like that. When it comes to money, pretty unemotional about it, which allows me to make purely financial decisions. So if we look at the scenario of investment planning, we don't see a lot of times people focusing on the debt side of the equation. And that's what we're trying to do, is just get you to focus on it, look at it, run some numbers, call our office, we'll help you run those numbers, we'll help you make those decisions. But what we find is that it's actually riskier in the long term to divert money from your investment savings to pay off a home mortgage quickly. The other thing, we'll get into some numbers here in a minute, but just from a standpoint of after 15 or 20 years you get your house paid off and you have nothing in the bank, what are you going to eat? And having this large amount of money tied up in a house, a lot of people found out in the past couple of years a house is an illiquid investment. And so we would prefer to have actual money in our account rather than it all tied up in one single piece of real estate. And so we're going to show you a way to do both in a smart financial way. So assuming you have a job, you have limited resources, you're trying to decide, well, should I put an extra $500 toward that mortgage today, or should I actually invest that money into a retirement account? So if we look at a scenario for today, I'm going to read some assumptions here I jotted down. So if we look at let's say $200,000 mortgages, if you borrow one at 15-year mortgage at say 3%, or you get a 30-year mortgage at say 3.5%. And actually the amount of the loan doesn't matter. I just picked $200,000, but it could be more, it could be less, as long as they're the same. Now we assume that the borrowers pay taxes at a 35% federal and state bracket. Once again, if you're in the 0% tax bracket or the 10 or 15, it's going to be a different equation. Now we set up a spreadsheet to compare these two. It's very easy to play with the rates and the tax amounts, but for this example, okay, and so for the return assumptions for the 30-year borrower, we're going to assume they can only earn 6%. In the 15-year borrower, we assume that they're going to earn 8%. And we'll play with those assumptions. They're probably a little bit aggressive, but we'll play with those assumptions as we move along. So we look at those two scenarios, and we have, if you look at a federal 25% and state 10%, you get a combined 32.5% tax rate. Okay, well, I see here we're running out of time for the second segment. When we come back, we'll continue talking about this age-old, very difficult decision whether to pay your mortgage down or to invest the money.